Bank of England held interest rates steady, even though UK inflation eased last month to 2%. The bank's benchmark rate remains at 5.25%, where it's been for the last 10 months. So why didn't it cut? The main culprit is services inflation, which was nearly 6% last month. And some economists think the bank will wait for that number to come down before further cuts are announced. James Smith is the developed markets economist at ING. I'm guessing you weren't surprised at the announcement. Most people were expecting. But they seem to be doing a Fed. They seem to be saying, look, it's good, it's the right direction, but we're not confident yet.
I think that's right. I mean, I think they were coming very close to cutting rates this month, actually. I mean, nobody was expecting it, but actually when you read into the statement and what they've said today, yes, there were already a couple of policymakers voting for a rate cut today, and the statement revealed that more were, quote, saying this decision was finely balanced. So we're clearly getting to the point where rates are going to be cut, clearly not quite there today. I think we will be there in August.
I suppose it does beg the question, what difference does it make, June or August? Just get on with it.
Yeah, I think you're absolutely right. And there were people out there saying, look, we're in an election campaign right now. Does that make a bit of a difference?
Yeah.
I don't think that will have made a huge amount of difference to the decision today. And I don't think it will after the election either. I think you're right. I think they do want to get on with the job. Listen to Andrew Bailey, the governor, last month. He was saying they could cut rates further than markets expect this year. So, yeah, I think we're clearly getting close.
What's your assessment of how quick and how low they go over the cutting cycle?
I think they'll do 3 rate cuts this year. That takes us to 4.5% by the end of 2024. I think we'll get another 100 basis points of rate cuts in the first half of next year. That takes us to 3.5%. And then I think we're nearly there. I think 3 to 3.5% is a reasonable point that we're likely to get to in this easing cycle.
How much of that easing cycle do you think will be passed on in things like mortgages and things where, we have seen in the past the institutions very quick to put them up, but as the rates come down, a little slower to pass that on, particularly if there's competition for funds?
What you've got to remember in the UK is that we're quite different to the US. So the US, of course, it's very common to take a 20 or 30-year mortgage. Now, the UK, it's very common to fix your mortgage, but for much less time, right. Typically 2 years or 5 years. So it's taken a bit of time for those rate hikes to come through, but they have come through in a much more meaningful way than we've seen, say, in the United States. It does mean it's going to take a bit longer for those rate cuts to come through as well for mortgage holders. But as I say, the transmission here is quicker than we're seeing across the pond.
Now, since we have a second or two longer to discuss this, why can the US do 25, 30-year fixed rates and almost no other country does it? Certainly the UK doesn't. The UK, lucky if you get 5 years. What is it structurally about the mortgage network and system in the US that allows them to do it other than greed elsewhere?
I honestly don't think there's any particular reason other than that's what's been traditionally done, to be honest. I mean, 10-year mortgages were becoming slightly more prevalent before all of these rate hikes came about. I think there'll be a lot more people considering them now we've had these rate hikes. So maybe over the next few years, maybe the UK mortgage market does look a bit more like the US. It would be sensible, right?
Well, talking of sensible, the election. Now, how nervous are either credit markets or equities ahead of the election, which, if polls are believed, will bring in a Labour government?
I don't think they're nervous at all, to be honest. And the main reason for that is that the incoming Labour Party is saying they're not really going to change much on tax or spending. Of course, in the UK, we've had our fair share of political turmoil over the last few years. Remember, a couple of years ago, big unfunded tax cuts were brought about. Markets sort of melted down in the aftermath of that. I think the situation now looks very different. I think politicians after that experience are very wary about doing anything that might upset markets. So I think it's looking quite boring, actually, for financial markets.
Right, but equities in London or in the UK market have underperformed, say, for example, the performance of equities in the US.
Yeah, that's absolutely true. Look, when we're talking about sort of markets investment, we're talking about business investment more widely in the UK economy. I think it's going to come down, amongst other things, to more stable policy making. Remember, one of the problems in the UK economy and facing investors as well is there's just been so much uncertainty and
Right.
volatility in policy making, Brexit, but also other issues as well. I think whoever comes in as the new government, I think the priority has really got to be bringing some stability, and that helps bring investment back in.
Just recapping what you were saying then, you're looking at 3 rate cuts for this year in the UK, 4.5%,
Yeah.
maybe another 100 and maybe another 1% previous, with a sort of a trough of around 3.5.
Yeah, 3.5. That's it exactly. Yeah, so much higher than we were used to
Oh.
pre-COVID.
Those of us of a certain age will remember that that's the norm. Thank you, sir. I'm very grateful for your attention tonight. Thank you.